So Joe's going to stick around, and we might ask you some questions at the end. Just go back a step. Joe made a very key point on that. A lot of people have government super funds which have really, really good insurance, and what we tend to do in that instance is, as Joe said, just leave it there sometimes, and you've really got to be careful you don't cancel those, because we've had many situations if you've got weight issues or health issues that you can't reinsure. So we'll say that again, and we've also said this a number of times because we do get asked that all the time as well. So who are they suitable for? You don't have to have this much money, but they're probably at a point where they're getting cost effective around that 200 to 250, and that's together. So remember, you can both stick, if you're husband and wife, you can stick your funds together. Again, you don't have to have that much, and if you're going to be considering borrowing and buying a property or something like that, you will end up with more than that under management, but just be aware that's about the tipping point where it becomes cost effective. So if you really want to be in more control and you've got the time and interest to do it, and you want to tailor your retirement plan, that's who should really think about these things. So we keep talking about property tonight, and that's because if you were going to buy other more traditional assets, you may be able to just do that through your normal super fund. So we're going down the path of just showing you things that you can only do with an SMSF, and buying a residential property is one of them. So you can go and buy a house around the corner if you want to. You can buy a commercial building if you want to, and that's particularly helpful for small business owners, as Joe mentioned. And you might decide to buy a property trust. For instance, an example in our lives, a lot of the staff here pooled their funds together, and we are investors in this building. So we bought the top floor together in a property trust, and that can be something you can do as well. You couldn't do that with an off-the-shelf property, off-the-shelf super fund. And one thing that you can do in an SMSF you can't do with a normal fund is borrow, and that's a relatively new thing. Joe mentioned 2007 she couldn't even do it. So it's become more and more popular, and it gives you a way to expand the amount of money you've got to invest in your super. Particularly advantageous for small business owners. If you have a commercial property in your super, it's a way for you to get money out of the business without paying workers' comp and superannuation guarantee on extra wages that you might pay yourself. Instead, you can pay yourself quite a decent rent, and it's going to somewhere that you're still controlling, being your self-managed fund. So it's not without its complexity, and that very confusing thing is the structure that you need if you're going to consider borrowing inside a super fund. So you need a super fund, and under the current legislation you also need a trust that holds the property on your behalf before you buy the property. And these two have an agreement between each other, and there's a lender involved. So it takes about 6 to 8 weeks to set these things up, and I don't want to dissuade you in thinking it's just too difficult. It's just a time and it's a process. So once it's all set up, it does run fairly similarly to what you would experience if you're running a property investment outside of superannuation. So the reason, this is not just centred around property either, this applies to anything, and why you might think about using superannuation rather than investing outside. I'll use property as an example here though. If you're going to go and buy a rental property, and let's say you made $200,000 on that, and you go to sell it down the track, if you're on a reasonable wage, you're going to have to pay capital gains tax at your marginal tax rate. So if you made, say, $100,000 as an easy example, half of that is taxable, and you'd have to pay $23,000 in tax on that 100 grand gain you've made. You do the same thing in super, and you're still working, the capital gains rate is 10%. There's a big difference there. Or if you leave it till you're retired and you're taking a pension, it's a big donut. Okay, so if you start thinking about accumulating assets inside your superannuation and you're going to unwind most of them around retirement, you can see what the government's trying to do here. They're trying to encourage you to do most of your stuff inside super, and you can imagine why, because you can't play with it, you can't take it to the races and what have you. So they want you to start accumulating funds inside super, and they'll reward you along the way with even the tax on a rent in super fund along the way is only 15%. When you're in pension mode, it's nothing. So as compared to doing it in your own name, you can see there's quite a big difference. So that applies to any of these sort of investments though, not just property. So we'll just give you, there's hundreds of strategies, we'll just give you two that we see all the time. And we call the first one the sea change strategy. We quite often encounter people who, I'll use Port Macquarie as an example. They've seen a place in Port Macquarie, 7 to 10 years out from retirement. they want to go and buy the house because they imagine they're going to move into that and then sell theirs on retirement. Unfortunately, they don't always end up at Port Macquarie, and what they quite often end up doing is selling it and moving down the road to a smaller house. So then they're in that capital gains environment they didn't want to be in, that we mentioned before, where they're selling it potentially paying top marginal rate, whereas they could have done it in their super fund, and whether they live in it or not, I'll show you a way that you can either get it out or sell it off and not pay any tax. And the other one is to transfer in, I've used commercial property as an example, but it could be a large parcel of shares as well, to get some cash out of your super and use that personally. So I'll show you a couple of those. So, this is pretty common. Helen and Bob, they've got a personal residence valued at 700. So they've decided to go up and set up a self-managed super fund. They've got about 300 combined. And they've seen a place, and I joked about this last week, it looks like it's in America, but it's supposed to be Port Macquarie. And it's worth about $420, and they're wondering how they should buy it, and they've come to ask us the best idea. So, what we suggested was, because of their distance to retirement being fairly close, we suggested that they use about 220 of their super and then use a bare trust arrangement to purchase the property and take out a loan for $200,000 in their super fund to buy it. Once it's set up, it looks a bit complicated, but really it's just all happening within the super fund. So the super fund's paying any ongoing administration, it's not coming out of your pocket. It's paying for any expenses on the property. So you have to get out the super fund checkbook to pay for the rates and those sorts of things. It's paying for the interest on the loan. You're not. Okay, the super fund has that responsibility. And because it's getting the joy of paying all the costs, it also has to obviously get the rent. So the rent goes into the pot as well. And you manage that bank account just as you would if it was outside super, but it's just a strategy happening inside. And then you might talk to your advisor or accountant who suggests that you take advantage of your limits. So if you're under 50 years of age, we might try to get you both to put anything up to $25,000 in each. And by putting it into super, it's only getting taxed at 15%, whereas outside it'd be getting taxed at greater. If you're over 50, between the two of you, you could stick in up to 100,000. So you can build up your cash inside the super. You haven't used all your money to buy the property because you've borrowed, and you can start to buy shares and other things and diversify a little bit. So you carry on that way until you're retired, and then when they're retired, they decide they want to live in Port Macquarie. So at that point, the first thing we'll get them to do is start an income stream out of their fund, because you might remember back that turns it into a 0% tax environment. Then they would, assuming these debts are gone, they could either be paid down along the way or retired by other cash that might be in the fund, but let's assume that was taken care of. They can transfer the property out as a tax-free lump sum. They pay no tax on capital gains tax, and they don't pay any tax taking it out. So effectively it's a transfer form. There's no stamp duty in most states at the moment. If you transfer it out as well, because it's a related party, you're the beneficiary of the fund. So you basically get Port Macquarie out, you get to keep any gains, and probably the most important thing is they're not under any pressure to sell their residence quickly. Normally these two things are happening at the same time. So you're selling at Wamberal or wherever you live, and you're trying to buy Port Macquarie. You don't want to be homeless for a week, so you try and coincide those. You don't quite get the price you want on Wamberal because you're thinking about, I've got to get to Port Macquarie. They can take the luxury of selling this over a period of time, and then they would speak to their advisor and accountant and just navigate how they get that into the super fund, because this here will then form part of how they're going to pay themselves an income stream. So it doesn't matter whether they end up living in that. They just can't live in it when it's in the super fund, so they have to get it out if they want to live in it. If they decide they want to keep it, fine. It's at 0% tax on the rent. If they decide they want to sell it and buy something else inside the super fund, they can. There's 0% tax. Does that make sense? So that's one way to go and buy a property, and it doesn't have to be a retirement property. That rule applies to any sort of property investment, and Ralph's going to show you a couple of ideas there later. So I think I just went through that, but they've purchased the retirement property, haven't paid any capital gains tax. They've got flexibility in selling their place. No stamp duty payable on transfer. They're the sexy, exciting things. And before you ask, no, you can't put your nana in it. No, you can't rent it to the kids. No, it shouldn't be a holiday property that you go and stay in. So you've got to remember that you can't mix these two things. If you've got existing residential houses, unfortunately, this legislation might change. I'll take Joe's feeling on that. But at the moment, if you've gone and accumulated 10 properties outside of super, the only way you can get them in, if they're residential, is to sell them. put cash into super and then go and buy again, so that's unfortunate. This is probably more useful to business owners, but this commercial property could be anything that you can transfer into super. So it could be shares. So you could have $210,000 of Commonwealth Bank shares that you got given from your nana, and they've been sitting there and you didn't know quite what to do with them. They could easily be this here. And the strategy is that they've got a big personal debt and an asset outside super that they own, and we want to see if we can combine those two to get a better result. This is pretty common because Mary and Bill bought their business ages ago. They thought they were doing the right thing. They paid the loan down on the commercial property, and then later on kids and so forth came along and they went and bought a house and they're still left with a mortgage. So they've got their tax deductible property out here with no debt on it, and they've got a personal mortgage on the house they're living in with no tax benefit. So what can you do? They can transfer that in there if they wish, and they can then subsequently take that cash out if they want to, which is the same value as what they paid for the property. So I'll send $10,000 to thin air there for costs, but assuming that they transfer it in, they then get $200,000, they can relieve the mortgage on their house. So now they've got a commercial property inside super and no mortgage on their house. So they've got rid of about $14,000 of interest payments, which if you gross that up, that's going to be getting closer to 20 of the amount they'd have to earn to pay that mortgage. The commercial rent they were getting from the property, they're saving $2,500 in tax by having it inside the super fund. And if we sell it when they retire, they might not pay any capital gains tax on it. We've just got to worry how much it was when they bought it, because it's considered a purchase by the super fund, so there'd be stamp duty to get it in there. And there may be a bit of capital gains tax to get it in there, but thankfully, well, not thankfully, but commercial properties typically don't grow a great deal. They're more an income sort of investment. And the other issue to consider, if you've got all your money in the commercial property and it's in the wrong area, you've got all your eggs in one basket, so there's not a lot of diversification. But broadly, we would recommend that's probably a pretty good thing to transfer that in. Okay, so buying property in super. It's no different to buying it outside. If you buy rubbish, you will get a terrible result. You also shouldn't be considering buying houses across the street, for example, because then you've got a house in Wambrill and one across the street. In your super fund, there's a problem specific to Wambrill. Your main house has got a problem. Your super's got a problem. You've got a big problem. So property is just another investment. You've got to think of it just as you would coldly if you're buying Commonwealth Bank shares. Do I want to own Commonwealth? What are the earnings of Commonwealth going to be like? Do I expect they're going to pay an income? Same with the property. Where is it? What are the growth opportunities? Is it going to pay consistent rent? Do I want to hold this just like any other investment? You can buy any sort of property you like, realistically. Commercial retail office shed, particularly helpful for business owners. There's no restriction on the types of properties really you can buy. You might choose to buy a property trust, but you can buy units or a freestanding house, doesn't matter. So what I might do is, Ralph works in our property division, and at the moment we've got access to a number of developers, and also we're using a property screening service which looks exactly what we said before. Location, rent, growth prospects, the actual quality of the build, and they don't, the filters are also very strong in that they only accept very high grade properties, and they could be anywhere. So realistically, what we do as advisors, if we're looking at something and it's 300,000, we don't only look in Wambrill. We go, okay, what's the best thing for you for 300,000 for the timeline that you've got? It might be in Whoop Whoop, and that might be the best thing for you. It might be in Sydney. It might be a unit, it might be a freestanding house. And it's up to you, just like any other decision, to then pick one of those. But what Ralph's job is, he can help you go through those sorts of things, and from the stock that's available out there, which has been picked as investment grade, rather than thinking about whether it'd be nice to live in when you retire or those sort of things. The research is done as you would do with a stock pick, if that makes sense. I'll let Ralph just take you quickly through that.